From tax cuts to rate cuts, President Trump is betting big on 2026, but can it pay off? This is Macro Matters, and we're talking about the US economy. On Wednesday night, President Trump delivered a primetime address from the White House, part campaign rally, part economic pep talk. Americans are feeling the pinch. Rising prices have led to growing impatience with Trump's inability to deliver a better economy. Trump tried to ease those concerns with the guarantee of an economic boom unlike anything the world has seen. So will these promises turn to results? Let's ask Lauren Saidel-Baker, economist at ITR Economics. So Lauren, economists are projecting slightly faster US growth in 2026, but tariffs remain the biggest downside risk. Are you still optimistic about the growth picture?
Yes, I do expect growth. To be clear, we are not forecasting a recession. However, it's that pace of growth that we really have to contend with in 2026. Our overall forecast is for just over 2% GDP growth next year. Now, that is going to feel different across different industries and certainly across different consumer groups, as inflation is really taking a bite out of paychecks for some.
Let's keep with inflation. It has eased from the 4-decade high of 2022, but prices are still climbing. Can Trump realistically deliver on his promise to bring down prices quickly?
To bring down prices, no. That would entail deflation, and deflation, first of all, is a very dangerous thing economically, but it's also very rare. We have so many structural pieces in place for, I would not even argue continued disinflation, but for rising inflation. We saw in today's numbers, inflation on the CPI basis, it did come in lower than expected, but still above that 2% target that the Fed is looking for. We have so many structural factors just from the sheer amount of liquidity out there, from wage pressures, from rising electrical costs, not to mention that rather accommodative both fiscal and monetary policy position, that we are going to see some upside pressure on inflation in 2026. Our view is for that number to creep back up above 2, 3, and even close to 4% this year. Again, that's not the 9% peak that we saw back in 2022, but that is above trend, and that is above where many consumers would feel comfortable.
Let's turn to the labour markets, and the unemployment rate is at a 4-year high, highlighting the employment struggle that many Americans are facing. Do you expect this job market pessimism to continue?
Quite simply, if you look at the job creation rate, that's being skewed by immigration in the United States right now. So I see the lack of available workforce as being the predominant issue here. We have baby boomers starting to retire, and we don't have the same number of new, younger workers entering the labor market to offset that on a one-to-one basis. So I think demographics are against us. However, here's where, again, we get more movement beneath the surface. On average, today in the U.S., we have just about one unemployed worker for each one available job opening. So all told, we are fairly balanced, but within key sectors, there really is that limited labor availability. And I don't see anything particularly moving the needle in the near term. Eventually, AI could make some gains here, but we don't have new gluts of workers coming onto the scene. So I think that's going to keep the labor market relatively tight. Yes, maybe there will need to be some reskilling, but I don't see the bottom falling out or things getting materially looser.
Well, Trump did mention his appointment of a new Fed chair, suggesting they would lower rates, yet markets are only pricing in 2 more cuts. So which narrative will win out?
I do expect the next Fed chair to be more dovish than Powell has been. However, that's only one vote when it comes down to it. We'll see if Powell keeps his seat after not being chair anymore. That's up in the air still. But this is a committee of individuals who are voting on interest rate policy. And as we do see those inflationary pressures starting to build, the Fed does not want to let inflation run away from them again. So I think there's going to be a real limit to the number of additional cuts they can make. We're starting to see the narrative shift in that direction. Certainly bond market signals are saying that the smart money, so to speak, is expecting relatively fewer additional cuts.
Some more data to go through, and US business activity slowed in December to its weakest pace since June, with new orders falling across sectors. Does this signal a tough time for businesses next year?
I think next year will look better than this year does in terms of business spending. However, there are a few things that are really just delaying the momentum build up. Clearly, there was a lot of pessimism, a lot of uncertainty throughout 2025. We had tariffs were the big one, but there were so many other policy pieces that businesses just had to decide how to contend with. The good news is we're largely through the biggest surge of uncertainty there. So the groundwork is a little bit more firm. That's giving businesses the confidence they need to start to move forward.
So finally, Lauren, a key question is whether US tech can capitalize on their massive AI investments. So if the hype fades, could the US face a recession?
I don't think at this point the tech or the AI bubble, so to speak, would be enough to cause us to enter recession. A lot of these gains I see as being more medium to long term. We don't have immediate solutions for how AI can make us more productive. It's still being worked out. There's still a lot of moving pieces there. Clearly, the investment in things like data centers here is just so huge that is benefiting a lot of sectors from, construction, energy is another big one. But at the end of the day, it's just going to matter which companies can find good ways to implement these AI gains. They are going to be the winners this cycle.
That was Lauren Saidel-Baker from ITR Economics. Don't forget, you can watch more videos on Reuters.com.